There are signs that growth is improving in the U.S., says our next guest, although there are some analysts, the latest coming out of Goldman Sachs, who argue President Trump might not actually jumpstart growth in the country. So what could this all mean for gold? Joining us now is Kevin Caron, market strategist for Stifel. Kevin, thanks so much for joining us on Kitco's Gold Report.
It's good to be here.
So let's start with gold here. The metal off to a good start in 2017, but still up against a rallying stock market and a U.S. dollar. Do you think gold's 2017 rally has run its course, or could it have more room to grow here?
It's gotten out of the gate with a very good start, of course, and it has so far exceeded our expectation as a return for the year. I think we lowered our expectation last year to around about 3% as a kind of a long-term expectation, just slightly above the inflation rate. So it's very hard. It's obviously a very hard and volatile commodity to predict. We think it has a role in portfolios still, but we're still a bit cautious on the metal and somewhat underweight.
So I know reading offline, Stifel's strategy is to have, like you mentioned, a reduced gold exposure here. But what are your forecasts in terms of price for gold? Where do you see the metal headed this year?
Yeah, just as a point of clarity, I represent Stifel's Washington Crossing Advisors Group, not the opinion of the overall firm Stifel. But I would say that our expectation would be for a trend line higher in the gold price, but a more modest kind of pace of growth than we've seen in recent years. And there are several reasons why. Number one, when you look at when gold performs well, it's typically when you either have some kind of very noticeable inflation or you have very low negative interest rates, as was the case a few years ago. That seems to be going away. The dollar strengthening, growth here in the United States is picking up. So our best bet would be that the dollar remains strong. Growth is is looking reasonably good given the data. So looking around at the various asset classes, gold would not be the one that we would go to immediately given the trends we're currently seeing in the data.
So, we both mentioned equities, the dollar, rate hikes as threats here to gold. Do you see another one that I've not mentioned that could really, give gold a surprise here?
Well, I think that ultimately there are lots of things that can move the gold price around, and it's notoriously volatile. But if you look at what really gold is, or the way we think about it, as a store of value over very long periods of time, you'd have to link it ultimately to the growth in the money supply and the productive capacity of the global economy. So what are we seeing there? We've seen a very big boom in credit, first in the United States, then in emerging markets. Seems to be cooling off somewhat, so slower growth in the monetary aggregates, probably speaking to a lower kind of inflation rate than we've seen in the past. And when you think about where we are in terms of interest rates, very low real interest rates, quantitative easing, all of those kind of extraordinary measures, those are bleeding off as capacity is being drawn down in the U.S., as growth is picking up. So there isn't an obvious thing to provide an upside catalyst. We don't see a big drop in the gold price in store. We just don't see very much by way of robust growth and upside in the price from here.
Right. So is there an area in the economy right now that you would say you are bullish on? What sector are you liking?
Yeah, well, we like the consumer. The consumer has been it's been a stalwart part of the expansion, particularly here in the United States. We are seeing decent trends in terms of spending and consumption, and the job market looks good and wages look good. So we would stick with that. And plus, when you look at where we are in the cycle, 90 months plus into a recovery here in the United States, I think you want to start to move up the quality spectrum within the composition of it. Let's say an equity portfolio, consumption tends to be relatively consistent versus things like materials or capital goods type companies. So I think we tend to be migrating in that direction, more consumer-oriented names at this point.
Kevin, it was good meeting you and great chatting with you today. Thanks for joining us.
Likewise. Thank you.
And thank you for watching. Be sure to stay tuned for our coverage of the BMO Metals and Mining Conference. It's coming up in a few weeks. Be sure to stay tuned, and we'll see you back here tomorrow.